All right, folks. So married, what does it mean to be married for federal tax purposes and for state tax purposes? Well, in general, if you've been married, right, and you've been married under some sort of state law or possession or territory of the U.S., then you're considered married for federal tax purposes. As well, the law defines same-sex married couples as married, as long as it's recognized as a marriage under some foreign government agency or a state possession of the U.S. Basically, that's good to go. That's pretty straight up to me, very straightforward, nothing really there. There's sometimes, they have the situation, and I'll just point it out real quick, then we'll move along with the same-sex registered domestic partners that are considered married for state tax purposes, but for federal tax purposes, that would not be recognized. It actually has to be same-sex marriage. All right, and something important to go through is the abandoned spouse rule. Basically, when you're still married and one spouse goes MIA, kind of leaves you with the children and says, I'll see you later, and you're not technically divorced, legally speaking, you're still married, what you would do is you would go ahead and file head of household, and the other spouse would do married filing separately. This will help strategically increase the tax deductions available for the person that's taking care of the children and maintaining a home for the children. All right, so that's under the abandoned spouse rule. Now, marital status, I'll say, is pretty important. And the reason is, once you're married, we have this term called jointly and severally liable, or individually liable, what have you. And that means that once you're filing jointly for a tax debt, that may arise from the filing, you're basically both 50-50 on the hook, all right? So that's a really important concept, and that's what we call, again, jointly and severally liable. So you and I both file. Let's say you have a much higher tax debt than I do because you make most of the income. And let's say, for argument's sake, I just don't have any income and I'm married with you and I'm filing married jointly together with you, then all of a sudden I'm 50% liable on this tremendous tax debt that I can't pay for or anything like that. So that's a big eye-opener for some people. I want that to really sink in and to understand the gravity of that situation, that even if one spouse goes for bankruptcy, the IRS will immediately drop that spouse, put him on the back burner, and go right after the other spouse for the remaining balance. You got to be careful with this, okay? So that's why we say it's really, you're like kind of on the hook for this tax liability. Now, when is the marital status determined? Well, it's determined as of the last day of the year. So you can be single all year long. You go out, you get married on December 31st. For tax purposes, you're married as of that year. It doesn't work that way in the abandoned spouse rule. In the abandoned spouse rule, it goes for at least 6 months. The person is gone out of the household, for the last 6 months of the year. Here we're discussing just somebody gets married. Okay, it's not an abandonment of spouse. Married filing separately. Okay, so now is the time to really talk about what is married filing separately versus jointly. Who came up with this idea? Why was it a good idea? I don't really know why it was done, but I guess it's just to kind of separate things out, legally speaking. And you can do married filing separately, where you're saying, well, I don't want to be on the hook for anything of this spouse of mine, and whatever their tax bill comes out to with their income and their earnings and their deductions is fine by me. I'm just gonna file on my own right here. I'm still showing that I'm a married person, but I'm just gonna file separately. All right, that's going to help me avoid any of this attachment for liability with the government. Okay, the other way to avoid this is through what we call innocent spouse relief, and it's very much rarely done. I think in my career as an accountant, as a tax accountant, I've only done it once, and that was per request of the client. And this is basically shining a light onto the other spouse's tax return and saying, hey, I don't know what's on that side of the return, but I'm also on it, and I have nothing to say or do about it. This relief can be done in basically 3 levels, and it can get more intense as we go. And you can also check your availability to claim innocent spouse relief on the irs.gov website. You can go into the search bar and type in innocent spouse relief, and it'll take you from there. Also, innocent spouse relief is not to be confused with injured spouse. Injured spouse is dealing with a tax refund situation where you're requesting a refund that's due to you, and basically asking the IRS to bypass any tax collection action against your spouse. So sometimes, let's say I'm married with somebody and they haven't paid their taxes, or they haven't paid their student loans, or some other kind of debt, okay, from, like, let's say, because the state, if I owe the state money for some other infraction or some what have you, it can be credit card debts, it can be a whole host of things, tax debts with the state, and I'm filing on federal side, and I owe somebody out their money, like the state, or like I said, credit card to somebody else, my refund can be up for grabs to those other collectors because they're in line to get my tax refund. Okay, but what happens if I'm married and that tax debt belongs to my husband, right? And I still want to do married jointly, then that's where injured spouse comes into play. Now, and I'm going to say, hey, there's a refund due here, and I have to show a special calculation that will reflect how this tax refund is due to my overpayment. It has nothing to do with the bad spouse that didn't pay their credit card bills or what have you, and now they're after him. So please don't touch my refund. I'm still entitled to my refund. I'm an injured spouse, quote unquote. So that's injured spouse. Don't confuse that with innocent spouse. Innocent spouse is basically saying, hey, I want nothing to do with this return. You're filing a form, basically shining a light on this whole situation, saying I want nothing to do with my spouse, even though I'm filing jointly. File separately already, take the hit. All right. That's enough about those 2 situations where I've actually done both. I've done the injured spouse and I've done the innocent spouse, and they're both, a little bit more involved than just the married jointly return. And again, why are they doing that? Because once they're, on the hook for this, they want to be, walking away with their conscience clear, not having to worry about the IRS coming knocking on the door down the road saying, hey, where's, I couldn't get money from this spouse, now I'm coming after you. So that's where married filing separately comes in, and married filing separately is a doozy, all right? When we're dealing with married filing separately, it's a whole world of its own, and it's a very common question that people will ask us, well, should I just do married filing separately? What does it mean to do jointly versus separately? And again, I go into how important it is to understand that you're on the hook for everything, but you have this other option. You have married filing separately. Do we ever actually see married filing separately work out in the tax liability world for the spouses? No. Like 95% of the cases, it will actually cost everybody as a family unit more money in tax overall because of the way the married filing separately status is designed by its, core design. So it basically, in a nutshell, married filing separately is discouraged by the tax law. And I'm going to repeat that again. It is discouraged by the tax law. If you file that way, yes, it will protect you from liability of the other spouse, but it will hurt you financially most likely. In 95% of the cases, and I'm talking about thousands of tax returns that we've prepared, I've yet to maybe see more than 2. So that number, 95%, is probably more like 99% of the cases. I'm just trying to give it some extra oomph there for standard deviation. Now, when we're dealing with married filing separately, and you know that there's issues on the other return, that's the time when it's good to do married filing separately. And there's another instance that it's done. It's when one spouse has large deductions and the other spouse does not. This way, that those deductions are not lost because the base on certain deductions, and I'm talking about itemized deductions, the base is really on combined income. So for example, medical expenses have a limitation of 7.5% of AGI, and that 7.5% of AGI would be lower if it's just on one spouse's income. So if one spouse has a lot of medical expenses, let's say $50,000 worth of medical expenses, and there's a limitation on them of 7.5 combined, and let's say my other spouse has a lot of income, I'd rather do married filing separately because then I don't lose a lot of my deductions. So in some cases, in those rare cases, it might actually make sense. Other than that, it's typically you want to do married jointly because you're averaging income with your spouse, and you're getting preferential tax treatment. And we'll go over the pros and the cons of each. But just know that married filing separately is basically discouraged. Everything's chopped in half in terms of what's allowed as in terms of adjustments to income and deductions. Certain rules are applied more stringently. Credits are disallowed. All sorts of things. Almost everything just goes like topsy-turvy, like haywire. Like, hey, we don't want you to do this, and it's just like discouraged, slapping you on the hand for every time you try to do married filing separately. No matter which way you turn, it's not going to look pretty. It's just going to end up like you're losing money all the time, and I mean significant money. Every time our software does have that, and most accounting professionals should be running a married jointly versus married separately scenario with the software and actually having it as a printout. Ours does. So when our clients receive the full tax package that they get for their personal income tax, there will be a report in there, and it's called MFJ versus MFS, or MFS versus MFJ, whichever direction you're going towards. And it actually shows you a comparison of how it is to file jointly and how it is to file separately between the two spouses. And then it spits out a number and says it's costing you so much money. And it's always like a dramatic number. It's always like in the thousands of dollars. So it will actually surprise you. The key is, again, to really tag everything in the software. And that's where professional knowledge comes into play, is when you know that, like, hey, I'm working on a community property state case here. We really have to tag all the items at, of income at 50-50. Whereas in, non-community property states, I have to tag everything to each spouse or split it for them. Who's picking up the kids? Who's, so there's rules that might start coming to play. So I have to tag, whenever I start to work on a tax return, I have to tag everybody and everything for their items of income, deduction, children, and so on, because at the end result, I have to know that we're having this report that we're kind of depending on to see if there was a possibility to save our client money by filing differently. There are some hitches in the law now that made it like with this economic payment that they were sending out, it was possible to double dip on that guy. But that was very specific to COVID and this economic stimulus payment that they were sending out, where there was this like kind of, I'd like to say blue moon kind of situation where if you married filing separately, you would double up on the economic stimulus. But other than that, we don't see that. That was a once in a lifetime thing. I think it was for tax season 2021. All right, so that's in a nutshell what all of this basically spells out. I'm just, I'm not reading it. I'm just trying to make sure that I didn't miss anything, because I'm not reading it, as you can tell. I'm rehearsing it because I wrote this down, and I just want to make sure I didn't miss any important points. So if you would bear with me. I want to make sure that we went over what is married, and obviously married is married. You understand that. If you're unmarried, you're unmarried. There's this special situation where if your spouse abandoned you for the last 6 months of the year, you have a kid, you can go with head of household. That's actually going to save you money, and that's the way you should be filing. We discussed that the marital status is determined as the last day of the year. If you're married separately, you have to be careful with, and we're giving you a bunch of this disclaimers. Be careful when you're married jointly, be careful when you're married separately, get a tax professional involved 100%. Did we discuss what cannot be done? Yes. Okay, so this is really important. I think I'll kick it off in the next one with the married jointly cannot be undone, and how that whole facet works, because that's a speech on its own. We talked about injured spouse and innocent spouse quite a bit, so this whole section was well covered. Okay, so this section I'm going to kick it off in the next one. Okay, and this one. It's basically talking about the same thing. I'm going to start off my next segment with that. All right, stay tuned. We'll talk again more.